All right, we'll give it a, hello everyone. We'll give it a few more minutes before we get started. Okay, I just a few things before we get started. I can already share now. First of all, welcome everyone. Thanks for taking the time. First of all, by default, you all are muted. If you have questions that are super urgent, feel free to unmute and jump in, or just post them in the chat and we'll monitor the chat and address questions as it makes sense. This call will be recorded and we will be posting, we're making it available online. So if you don't want to, if you don't want your face to be visible or your audio to be recorded, please just turn off the camera. And this should be interactive. So just feel free to ask questions, especially towards the later point. We'll sort of have a contract walkthrough that I'll be able to share more detail and go into some of the functionality we've built. I do want to start with a quick introduction on what Tinlake is and what Centrifuge is, and I'll try to not spend more than 5 minutes on that to get right into the depth of it. If you're unfamiliar with it, I'll be posting some more resources later on that'll act more as a primer, as an introduction. I won't be able to cover all of that ground in detail today, unfortunately, though. So we have three parts for the call today. I'll just, as I mentioned, I'll start it off with an introduction. I'm going to be using sort of an example use case as throughout the entire call, and I'll just sort of introduce a few parts of that, and then I'll jump into how we actually built the contracts and how they work. So Centrifuge at a glance, I think it's two main parts. We have a way to tokenize individual non-fungible assets to create NFTs. So what does that mean? It means you can take an off-chain asset, create, for example, or sort of any non-fungible asset, meaning invoices, purchase orders, sort of things that exist in the real world today that you want to use on a blockchain, right? So for example, to use the invoice, what you could do is you can create this invoice that is, say, worth $100,000 due in 90 days. You can create an NFT from that invoice that represents this claim on revenue. And so by then transferring this claim, you basically assign this revenue that your buyer is going to pay you to someone else. So essentially then by selling this NFT, by locking it up in a smart contract, you can sort of build financing use cases around that. And then we have Tinlake. Tinlake is our set of smart contracts that this call will be about today, where we allow bundling of these many different non-fungible assets, creating sort of one portfolio of assets with it, and then having investors invest in the portfolio as opposed to having to sort of do this one by one, invoice by invoice, or property title by property title, or who knows what. And so essentially, like, you have these asset originators that can create these assets and sort of bundle them in Tinlake, where then lenders can invest in and make liquidity available to the borrowers that want to borrow money on these assets. So just to explain, to go a bit more into detail of sort of how the overall architecture works, I'm going to be using, let's say we have this company here that wants to bring assets on chain, calling it Easy Billing. Easy Billing sort of creates these off-chain documents. It's an invoice with lots of information, like line items, tax information, delivery information, sort of all of the typical parts that an invoice belongs to. It then mints an NFT that we push into Ethereum. This NFT now just has this limited public information that you want to be able to price the asset, to be able to evaluate the asset, and then to, most importantly, track ownership of what happens to this invoice as you like put it into Tinlake and like have lenders invest in these assets. And so we'll go into more detail on what that looks like. But essentially, so once we have these NFTs on chain, we put them into a set of smart contracts that we call Tinlake, which you can think of as a structured money market for debt. So Tinlake has these two sides. You have the borrower side, here the left side, and you have the investor side. On the borrower side, you have all of these different NFTs and a couple of dozen different invoices, for example, that make up this portfolio that you want to invest in. Each one of them has a different maturity date, different risk score, different interest rate, different amounts. And so Tinlake sort of keeps track of these individual assets and manages the cash flow, the cash flows from these loans. So you can have a collection of different NFTs that yield different interest, have different maturity dates, and so on. The Tinlake contracts actually then allow borrowers, for depositing these NFTs in Tinlake, it then pays out a stable coin such as DAI to the borrowers that can then use that money and upon maturity repay to get their collateral back. Then we have, on the other side, we have two tokens, and I'll get into detail why two later. But essentially, we have these ERC20 tokens that represent an investment in the pool. So what investors do is investors buy drop or tin tokens for a certain amount of stablecoin. We mint these tokens, we give them to the investor, and that now represents their share of this portfolio of assets. The stablecoin that they invest is then made available to the borrowers, and as borrowers pay back their loans and get their NFTs back, the DAI that they return now gets paid back to the investors according to the shares that they own in this portfolio. So one key point here is like sort of we've built and designed this whole infrastructure with the idea that we want to bring as much information on chain and have as much of the logic be sort of in smart contracts as possible. If you compare Tinlake to other security tokens and other sort of projects that try to tokenize real world assets, like oftentimes you have this very simple architecture where you just have a single issuer that mints an ERC20 token. And basically everything behind that operation is a black box, and you sort of rely on off-chain data, on sort of trusting the issuer that this really is a process that the legal process was followed, that these assets exist in the real world, and so on. And so with what we do with Tinlake, and sort of we go to the individual loan level. So instead of having an issuer collateralize a whole portfolio of assets, we have all of the information loan by loan on chain, and as more of this information, as more of the sort of the world gets connected to blockchain, we can make this more integrated into the existing processes. So by exposing this information on chain, hopefully you'll have a much better idea how to price them and have an idea of what's going on, what is really the underlying collateral behind the tokens that we mint here that we want to sell to investors or use in DeFi lending protocols. I mentioned the two different tokens earlier. And so essentially that one feature that the Tinlake contracts have that that make Tinlake assets an extremely interesting asset class for like DeFi lending protocols, but also for like larger institutional investors, is that we create a structured finance product. So this is in the traditional world, it's called senior tranche or junior tranche, or sometimes debt and equity, or A and B tranche. It essentially means that instead of having one share class or one ERC20 token in the crypto world that represents an ownership in this pool, we actually create two. And those two have different properties. The drop token is the senior tranche, which is sort of the more stable asset and gets paid back first. And so essentially how we do that is we use the TIN token holders investment to cover any losses that the drop token holders would have first. So the TIN token holders have a higher yield, but they also take a higher risk, because if there are any losses, we always pay the drop token holders out first. So that means that as a drop investor, you can invest in this extremely stable asset, knowing that there's a certain amount of TIN token holders that have invested that will cover any losses. So so how you typically do that is you would set up a pool with, let's assume we have $1 million pool or $1 million DAI pool. We raise 800,000 DAI from drop token holders and 200,000 DAI from TIN token holders or investors. So if the amount of money returned, and I'm simplifying here, not taking interest rate into account, but let's say we had to return 800,000 DAI to drop and 200,000 DAI to TIN. If there are any losses up to the 200,000, drop token holders would never suffer any losses, because of the $1 million, 800,000 would still be around. And only if those 200,000 TIN, this $200,000 TIN investment is surpassed, if the losses surpass that, then the drop token holders start suffering losses. And so what you do is you usually give the drop token a stable yield, and you have the TIN token holders sort of take whatever is left at the end of the lifetime of this portfolio. We are talking about like real world assets, meaning assets that essentially are a legal claim on some sort of property, revenue, or like any kind of asset you can think of. And so for those to actually work on chain, we do need a little bit of sort of legal framework. And so what we do is we have this, we set up the minimum amount of legal structure that is required to ensure that whatever happens on chain is also a legally binding, and that whoever interacts with these smart contracts on chain can actually then go in the real world and sue the company that isn't paying the invoice into bankruptcy, or like ask a collections agency to start collecting on these assets. And so the way we do that is we use a legal framework that is fairly established in the traditional world. Like debt funds are structured in a way that they have a special purpose vehicle that is just a specific legal entity that is created with the sole purpose of managing the assets on one side and managing the debtors on the other side. So what this SPV does is essentially, when an NFT gets put into a Tinlake contract, the asset originator has a loan agreement with that SPV that legally enforces that by transferring this NFT, the SPV now holds the asset. On the other side, the SPV has a loan agreement with the lenders, where essentially the lender now has a claim on the balance sheet of this SPV. So the NFTs, the assets that are transferred into this SPV, are now used to repay any debt that is represented by these ERC20 tokens. And so by using this structure, essentially, we can create a way that you can have these assets be managed on chain using Tinlake contracts, but you always have a legal recourse that you can rely on if you start needing to collect on the underlying collateral, meaning you need to go take this NFT and ask a collections agency to go and go after this invoice, for example. So when you think of these NFTs, we need a way to price them, right? Like, we need a way to determine how much money can be lent to an owner that has an NFT that they want to use to borrow money from. We need to determine what the interest rates are. We need to make sure that this legal construct is set up correctly. There's a whole bunch of this off-chain data, these pricing information that we need to get into Tinlake, the same way that you need to get ERC20 token prices in today. And so there's a few things that go into pricing real-world assets. You have the provenance and title, which is just essentially, which is making sure that the legal paperwork is actually correct, and that this NFT that is in Tinlake actually also, that the asset that is represented by this NFT is also properly transferred to the SPV, and so that the SPV has this legal claim, and that you can sort of be safe in case something goes wrong. Rehypothecation is if an asset gets pledged twice. So that's a common fraud scenario that happens when borrowing money, is that you try to get money from two different banks, and you give both of them, tell them, here, I have this asset, you can now I want to use it as collateral and I want to borrow money from you. But in the end, like, you need to make sure that only the borrower only pledges this asset to one entity. And so there's companies that can deal with analyzing these portfolios and making sure that this rehypothecation doesn't happen, that you don't have fraudulent assets. Then you have rating, which essentially just like rating the credit risk of the borrower itself. And then, of course, you need to value the asset, and that depends very much on what kind of asset you're pricing, right? An invoice is going to be priced very differently than a house. It depends on the country, on the asset type, on the currency, and so on. So sort of upfront, before like even accepting any assets into Tinlake as a candidate for a loan, so we go through this list of criteria, and Oracle provides this information and ensures that that this asset is admissible. As the loan matures, sort of like the borrower borrows money, the loan matures, like the price of the underlying value of the asset can change, and so the valuation you need to evaluate on an ongoing basis, as well as sort of then what the estimated market value of this loan is, which then results actually in a token price that the investors see, right? So sort of the mix up of all of these individual NFTs, the revenue that are expected from these loans in sum make up the value of the tin token investment and the drop token investment. And so those are sort of the external data sources that we need to feed into Tinlake to be able to have an idea of how to price the NFTs and how to price the ERC20 tokens, the drop in tin. So that was a very compressed like overview of what Tinlake does. Maybe we can do just a few quick questions if there are any. And I can, before go into like walking through an example. So if you have any questions, just post them in the chat and I'll try to answer them. if so, okay. So question: when do investors receive interest payments? So tin and drop essentially work the same as a CDI or like sort of these index tokens. So when you have the drop token basically has an exchange rate from DAI to drop, and your exchange rate, let's say it starts at 1.1. At some point, your interest starts accruing. Now the exchange rate goes up. You instead of getting 1 DAI for 1 drop, you get 1.1 DAI for drop. So that's how interest is being accumulated. For tin token holders, actually, there's no fixed interest. Essentially, the way it works is you have over the overall portfolio of assets. You, for example, have an 8% interest rate, and you're paying the drop token holders 5% interest. So you have this 4% interest spread and a little bit more to pay out the tin token holders. So the tin token holders just wait until loans have been repaid, and if there are any leftovers, meaning there were no defaults, and this 4% interest rate difference is then being used to pay the tin token holders. So on our hypothetical $1 million portfolio with 8% interest and 5% interest paid to the senior, tin token holders can make like in the double digit percentage yield if they do a good job if the portfolio is well underwritten. And we have an article on Medium that sort of goes through a few of these details. There's a link at the end I'll share where you can sort of read about this. As opposed to as to when exactly the investors receive. Essentially, you can withdraw money from a Tinlake pool whenever there's excess liquidity. So when borrowers repay or when not all of the money has been invested yet. Then a question: what happens upon Tinlake bankruptcy? So when we have Tinlake bankruptcy, there's two different. Let me go back to use this example here. There's 2 different places where you can have a bankruptcy. You can have like one single NFT go bad. Let's say you have a dozen invoices in here and one particular buyer is not paying back. That at this point, actually, you can try to liquidate this individual NFT before the entire portfolio goes bankrupt. So there's a little bit of buffer that you have where the 200,000 DAI that the tin token holders invested, right, might cover some of the loss, and you might not have a complete default of the portfolio if just one asset goes bad. And so what you do then is you liquidate this NFT. We have something similar to the MakerDAO keepers that then bid on these distressed NFTs and these loans that are not being paid back. You try to recover as much as possible, and the rest you sort of account for as a loss. And so you can do that as long as the overall value of the portfolio is still within acceptable bounds, right? Like default of assets is always priced in. Like you charge interest to make sure that to cover for eventual losses. If, however, something unexpected happens and the entire portfolio is worth a lot less than expected, then actually what happens is you could have investors that want to say here, and for example, a Maker Vault would be one of the potential investors. You could have them say, actually, we want to get rid of our drop and we want to liquidate as soon as possible and get our money back. This essentially puts this entire pool into default. And so by putting that entire pool into default, the Tinlake contracts will stop accepting new loans here, and we'll just wait until these NFTs have been repaid. Or alternatively, you can set it up such that then all of these NFTs will be liquidated, and keepers would then sort of buy these individual loans, and the money would be returned to the token holders on an ongoing basis as money comes in from the borrowers. So there's a few questions about yeah, so a few questions on Oracle and pricing. It's a bit hard to give generic answers to what these oracles look like in particular here. The reason is just that we built Tinlake with sort of any kind of asset in mind, actually, whether that's a real world asset or CryptoKitties or some sort of crypto NFT. But for these assets, even within the class of real world assets, a house is priced very differently than an invoice. And so when setting up a pool, essentially the asset originators that want to create this pool, and I'll go into detail a bit more of how that will look, they will work with data sources that exist today already. So like underwriters or credit risk modelers, fraud prevention companies to create the safest, best oracle they can, and that can then be like, could be an immediate thing, or it could be any, like, sort of could take a little while. For the rest of some of the questions, I'll get into a little bit more later when we look at the contract itself. One of the questions I still want to address at this point, Makerman, you asked about what is the collateralization level of the NFT relative to the loan amount. I think that again depends on the asset class. Like, for example, if you buy a home in the US, you can usually sometimes you can get as low as 10% down payment, sometimes it's 20%. So that sort of essentially translates to the collateralization rate. For supply chain finance invoices, they usually see an advance rate, they call it there, where 80% of the invoice value is paid ahead of time and then sort of advanced. So that would be, or sometimes up to 90%, where that you pay out. So that would be the sort of the collateralization level for NFTs and invoices. But again, this sort of depends on the kind of asset you have. And I think one important part that I didn't mention yet is, so this set of smart contract, the Tinlake contracts that we have, they are actually, we deploy a set of these contracts for each asset class, right? So the assets that go in here, say you have invoices in the US for small businesses, like that would be one deployment of Tinlake, where all of the risk is shared among all of the investors in that particular pool. And you create a different deployment for a different set of assets, where different investors could buy the drop and tin tokens that would have a completely different default rate. So when I talk about sometimes it's 80% advance rate, sometimes it's 70, sometimes it's 90, what you would do is you would create a specific deployment for the kind of assets that you want to finance using Tinlake, and then set up these parameters for each one of these deployments. So I'll move ahead a little bit, and then if some of the questions are still unanswered, I'll try to address them at the end. So I want to just,
Lucas,
yeah,
it's Jason here. We're taking down all the questions as well, and we'll make sure to follow up with everybody if we miss any.
Okay, cool. So I've explained a little bit how the contracts work, and I want to I've made up this fictional company, let's call it Easy Billing, that we'll sort of use as an example to explain how one would go about deploying a set of Tinlake contracts, what are some of the thoughts you'd want to put in ahead of time, and then how the contracts actually work. So Easy Billing is a software as a service product that allows its users to send invoices to their clients. Easy Billing actually realizes that they have a lot of valuable financial information and they want to start offering a factoring product to suppliers. So like Easy Billing goes and says, oh, actually the users that use my product, they would probably also want to finance these invoices. And if I can integrate that into my product, I can probably provide a much better user experience than what a supplier would do today when they would go to a bank. And so we assume that Easy Billing wants to access liquidity through DeFi, and they want to bring these assets on chain by deploying Tinlake. So we have this. So I'll use this character Easy Billing from now on as an example, and I'll sort of walk through the process. The first step is we have to create these NFTs, right? These non-fungible tokens. So in invoice, when you factor an invoice, you essentially create an obligation to pay, and you give that to someone else. So today you would go to a bank, you say, I have this this invoice worth $15,000. I need the money now and not only in 90 days when my customer promised to pay me. Are you willing to front this? And so we're gonna do this with Tinlake instead. So the first step is actually to create this NFT that represents this unpaid invoice. And so that can then be used as collateral in Tinlake. And so we have this off-chain document that has a whole bunch of information that we use, and we mint this NFT from, with just the minimum amount of public metadata that we want to disclose on chain, which is like the amount, the due date, and like sort of the owner address. And so we now have that. So Easy Billing essentially like integrates their product into, integrates Tinlake into their, and our NFTs into their product. And so now starts minting these NFTs for invoices that Easy Billing supplier want to factor. As a next step, Easy Billing needs to raise capital. So there's many different ways you can raise capital. Essentially, right, what Easy Billing wants to do is it wants to get investors to invest in Drop Token and in Tin Token. It actually, Easy Billing says, as a sign of good faith, or as a sign of confidence in our own assets and in our business, we're actually going to invest some of our own money into the Tin Token. So we're creating this $1 million pool of loans. We're going to put 200,000 of our own money into the Tin Token, and sort of any losses that occur, we're going to cover up to those 200,000. And we're looking now for investors who want to buy part of the $800,000 tranche. That's the drop. And so there's different ways. You can go to retail investors, or you can look at locking up assets into DeFi protocols. And so something else that Easy Billing wants to do is it wants to convince the maker community that these drop tokens that it's creating from the portfolio of invoices that it has is good collateral for maker, and so that it can actually, instead of selling these drop tokens to investors, it can deposit them in a vault and draw a DAI from it to fund its suppliers. So Easy Billing will go through this process. To be able to go through this process, and a lot of questions already were about sort of how do we price these assets? How do we make sure they're worth something? How do we make sure that the NFT is worth something? I just saw a question. If we support putting a bunch of interest yielding tokens up as collateral, Tinlake itself is not made for using anything other than NFTs as collateral, so it probably would not be a good idea. Then a question, which market platform will serve this process? That I would need to know a bit more in detail what you mean with market platform. But what we do is we create a public process where Easy Billing now recruits a bunch of third parties that can help with pricing these assets. These third parties will help. I'll get back to that question later. But so these third parties are sort of helping by providing their skills. So you have like legal and financial auditing firms that verify that the paperwork sort of about this that involves this SPV, that involves individual assets, is correct. A fraud scoring company might give a score to each individual asset that that sort of defines the risk of this asset being fraudulent. An evaluation firm can look at the different receivables and sort of the portfolio as a whole, and give an individual credit risk on the chance of default from one of the buyers that they might not pay back their invoice. And sort of with this pricing information, we can now, or sort of these different information type data, we can now create an oracle that gives a price for an NFT and a risk category for an NFT. So Alejandro, you asked how long does the pricing asset process take? In the end, it's hard to know. For invoices, it's something that can be done very quickly, right? Like a lot of the times those are very simple, like they're sort of fixed models that take a bunch of variables, and you come out with within the end a score that you can look at and multiply by the asset value. Sometimes you have to actually do a manual process where you'd want to review the paperwork, or possibly even like you would want to send an appraiser to the property and have a look at it and sort of get a third-party appraisal done. And so that it can be anywhere from like instant to taking a few days. But for invoices, this is something that's usually done in a fairly automated way. So sort of going through this process, Easy Billing sets up all of the necessary components. It creates a way to get the assets on chain. It creates a way. It sort of creates demand for the token by sort of either going straight to the market and asking retail investors to invest, or potentially like banks, or it decides to go and start a campaign with Maker and like ask the Maker community to consider onboarding these assets. So having gone through this process, now the next step is actually to deploy the contracts and sort of set up how all of this works that I've described now at a high level on chain. And so I'd like actually to sort of walk through just a little bit how these contracts work and how we're designed the system to be sort of to allow dealing with these different assets and different scenarios. And I'll try to go through that and then also leave enough time to answer questions. I see a lot of questions popping up in the chat, but just so I'll take 10 more minutes to go through these contracts and show what we actually do when you take an NFT and you deposit it. And for that, I'll switch into this illustration tool. And sort of this is the graphic that I showed you at the very beginning, where I had the borrower side on the left and the lender side on the right. We now have the same graphic with the difference that the borrower is sort of my lower half of the screen, and the lender contracts are on the upper half of the screen. And if you're familiar with the maker contracts, I think this probably reminds you a little bit of it. So like one of the design choices for coming up with these contracts is very much to create small modular contracts that can be replaced and customized quite easily to be able to deal with these vastly different asset classes. And I'll try to go through just a simple investor process, and I'll go through a borrower process. So let's start with the borrower process. And this is described in detail in the documentation that I'll share a link with later. But the borrower essentially starts by locking up their NFT in what we call the shelf. The shelf contract. The shelf contract keeps track of the NFTs, makes sure that all of so it manages the ERC20 token. We call this the currency. So this would be the DAI. So it transfers the currency from the investors to the borrowers, and it has a bunch of different data that or different data providers, so different data sources that we can use to define how the shelf should behave. We have three different prices we need to look at for each asset. We have the pile, which is for accruing interest. Ceiling a lot is sort of the debt, the total amount of money that can be borrowed for an asset, and the threshold is a maximum amount of debt that can accrue before the asset will get liquidated. Our keepers that can then get the individual NFTs out. And I'll switch back to the presentation. So I talked about oracles and about sort of easy billing, creating this pricing information. So easy billing has recruited these three individuals or companies that provide financial information based on for these NFTs. We have an auditor that looks at the paperwork, that makes sure that there are no issues with that. We have the fraud scoring company that looks at if there are any like systemic fraud, things like made up entities, double rehypothecation. And then we have a valuation firm that just looks at sort of the portfolio overall and looks at, okay, is there any cluster risk? Are there any, do these assets have a credit risk that is out of the ordinary? And sort of these three different data providers provide this data to an oracle, and this oracle then produces essentially a table of different NFTs that have a value and a risk score. And so based on this table, we can now configure these three modules. The pile can determine the interest rate, whether that particular invoice should have a 7% interest or an 11% interest rate. The ceiling, for example, could be configured in a way to just say, borrowers are generally allowed to borrow up to 80% of the face value of the asset. So for each NFT, it would just take 80% of the reported value. And the threshold, we'd say, okay, like if an asset's, if the debt surpasses 90% of the value, then we immediately liquidate that, and we try to sell off this collateral to keepers. So with that single oracle, we can now appropriately configure these three different sort of levers that we have in the system to make the shelf appropriately track debt, sort of accrue and increase the debt, so that we can make sure that the shelf never allows borrowing more than the defined ceiling. And if the threshold ever gets reached, the liquidators can claim the NFT and sort of seize that. That's sort of the very rough description of how these different contracts work. Essentially, this shelf guarantees that when, as a borrower, I deposit my NFT, I can borrow up to a certain amount. I get paid an interest rate that is defined here, coming from this oracle here, or this administrative function. And it also guarantees that, of course, the asset can only be liquidated and be taken away from me, meaning seized by a liquidator, if the threshold is reached. And as long as I sort of borrow and withdraw and repay fast enough, like sort of I can unlock my NFT and get the collateral back. So now, where does this money that we give to these borrowers actually come from, right? So this comes from the lender side, the part up here. On the lender side, we have this distributor that manages investments coming in from the senior tranche and the junior tranche, which both have these ERC20 tokens that represent the ownership that the investors now can own, that investors can sell and transfer. And it has a way that these assets are being, these ERC20 tokens are being sold for currency. So the operator allows an investor to deposit DAI in exchange for tin or in exchange for drop. Or the operator can be configured such that it takes the tin token or the drop token and deposits that into a vault and draws DAI automatically, where now the investor here is not a traditional user in a sense, but would be a set of smart contracts, a DeFi lending protocol. To be able to price these tokens and the exchange rate at which the investors can supply and redeem their drop and tin tokens, we actually look at this pool price, which looks at sort of all of these different which looks at the different assets locked up in the shelf, the different invoices, and calculates a price based on the outstanding debt, on the projected interest revenue, on the projected default rate, and sort of is able to give now a market value of what these drop tokens, or a net, so we call this net asset value, a net asset value of the drop token and also the tin token, of how much is expected to be returned to investors when sort of all of these loans have been repaid. And so the assessor sort of manages this the cash flows from the investors, accruing the interest that is owed to the senior, keeping track of how much is owed to the junior, and sort of making sure that as investors you get paid what you're supposed to get paid. So I want to leave the rest open for questions. I know this probably was a lot of new stuff to sort of go through in just an hour, especially at this technical level. But I want to post a few resources that we have, and then we can sort of open up the discussion. So the documentation goes through all of these different contracts and sort of how you set up the system, how you define it. You can find the link here. We have the code is public. It's being audited right now. It's not final, but it's pretty much done. You can look at it here. And then we do write a lot about the sort of our users and how they use it on Medium. So that's another good resource. And if you have any questions, we have a Slack channel that you can join as well and ask questions. But I'll try to just go through some of these questions. And if you have something that I'm missing, then please don't hesitate to like unmute yourself and speak up. So one of the questions is just like a reference to the 2008 crisis and how sort of how Tinlake could be better, or how it tries to be better than what we had there. And I think one of the issues about the 2008 crisis was that there was no transparency. And actually, like if you read about it in hindsight, like some of the like estimates of what the total exposure was in 2008 crisis, of how much of these assets actually were very bad, it's a fraction of the actual sort of distressed assets were a lot less than what a lot of people were estimating at the time. And I think that's sort of the one thing that the Tinlake contracts do give you, is that we use this information is transparent on chain, how much TIN token is backing a certain drop token, what the makeup of the individual assets are. We ensure that we sort of, if you were to like, you can't do this like wrapping and wrapping and wrapping of like one product and another product and another product, and so without making this very clear, right? And so that I think is a way that we can avoid creating these intransparent products that did lead to the financial crisis in 2008. So there's a question from Lix: is the interest rate based on DAI utilization similar to DYDX? So the interest rate is similar for investors, yes, in that we have interest rate coming in from borrowers on one side, and we pay out sort of a fraction of that interest to every drop investor. So the same way that you have in compound, you have a large supply, and low demand means you have a low interest rate for the people supplying the liquidity. If the supply shrinks relative to the demand, then that interest rate goes up. Then I'm just going through some of the other questions. So one question is, what can you tell, from Ben, what can you tell us about the go-to-market plan? Are there current invoicing companies or debt asset issuers that we're speaking with and that we're onboarding on day one? Yes. So we have, I think right now, five partners that are working on setting up these portfolios. They vary from in like geography, in asset type, but I think 3 trade finance assets, one real estate, and I think one commodities partner. They're sort of we're aiming for a soft launch in the next couple of weeks to months with some of these first partners, where we're setting up relatively small pools, so like sub $1 million, and then sort of growing it from there. So it seems, so there's a question, it seems like the incentives are only aligned if the drop tokens are held by Easy Billing, Tinlake, or other systems. Only that would stop them from allowing bad collateral. That question was asked by Johannes. I think maybe you're confusing the two. So essentially, we achieve that Easy Billing has aligned incentives with all of the other investors by having Easy Billing invest in the TIN token, because Easy Billing wants to make sure that it doesn't lose out on its investment, and they do that by investing in TIN. Because if they do underwrite bad collateral, if they do create bad collateral in a Tinlake pool, that means that they will suffer losses first. So yeah, you just said yeah. So the TIN token is a way to incentivize the asset originator to have skin in the game and to make sure that the product that they sort of offer to the senior investors, the drop investors, that is a good product. So Primoz Cordes asks, how much of the invested amount is left unutilized for quick and easy redemption, and who manages this? If I go back to this illustration, we have like this assessor here, which if you look at the legend is a yellow contract, which for us means that it's something that you can take and customize. In the end, these operators and the assessor can be tweaked to have a higher utilization rate or lower utilization rate. You can use different investment schedules. In the end, you want to, this will depend on how liquid the underlying assets are, right? Like on a pool of invoices where the average maturity date is 40 days later, that's maybe very different than on like a very illiquid portfolio of loans where like you have a maturity date of a few years, or like mortgage is even longer, right? And so all of these things you can sort of tweak depending on the asset that you have. So Makerman, you asked that we have at least 3 to 5 different trust brokers here, whoever is auditing the assets, the legal jurisdiction, the asset pricing, and so on. So the thing we do there is if we go back to this slide, what we're trying to do is we're trying to create a system where like each individual data point cannot fundamentally break the system, and we try to have redundancy in these so that you can have different auditors audit the system. You can have fraud scoring done by different entities, and so transparently show this information on chain, reducing the need in one centralized layer of trust. The one piece where we do have centralization, and I think that's just something that's inherent with the legal system we live in today, is that of course you rely on this SPV being there to be able to enforce your claim on these assets, and that is centralization compared to what we're used to in crypto assets. But it's also a model that is used every day today in the financial industry to sort of manage traditional financial products. So you're sort of you're in a way trading off complete trustlessness. But what you're getting in return is actually that these real world assets are extremely stable to the US dollar. They have very uncorrelated risk to the other crypto assets, if you think of it from a maker's perspective. And of course, like within these different pools of assets, you can have redundancy. You can have different jurisdictions. You can have different asset classes. And so on, sort of to remove to sort of get rid of this one point of failure. I think we're coming to the end. If there's anything that you want to still ask that I haven't addressed, all right, let me know. I'm monitoring the chat. Is there? So last question, okay, that's the last question. We're close to the hour. How do you set interest rate and deal structure for a given asset pool? It's a bit of a cop-out, the answer I'm going to give you, unfortunately, but in the end, this relies on the asset class, right? And so interest rates are being set where the asset originator will have to work on making as much information available to these different pricing, to these Oracle providers, to be able to give as accurate information, as accurate of a pricing on them as possible. And so that's what will essentially set the interest rate. The more you can reduce trust, the more information you can make available, the lower you can drive down these interest rates. So I think we're gonna end it here. so with that in mind, we're going to be posting the recording on Twitter. There's also a thread on the MakerDAO forum that I'll be posting a link to the recording on. And actually, Gustav from MakerDAO and I will be talking about real world assets at ECC. It's on the 4th of March at 5:30 p.m. European time, where we'll be talking about how we can open up DeFi to the real world by bringing assets like that on chain. So come say hi, ask me a question. Thanks for the great participation, and I hope I was able to explain a little bit what we're doing. All right, thanks a lot. Have a good one.